Hi, welcome to this episode of Industry Voice. And today I have Susan Holliday and David Crosbie joining the show. And how's everyone doing today?
Thank you.
Great, thanks. Hi.
So this is not going to be like any of the other episodes we have done here so far. This is going to be a great one. And let's just do some background introductions, and then I'll let the panel introduce themselves. We were talking about crypto and then the use case in crypto in insurance. And then I think Susan started having a conversation with me. And then next thing you know, David came in. And I thought, you know what? This would be a fantastic episode, bringing some industry expert in both use cases and in the crypto world and the insurance world. And then let's just talk about it. Let's put it on the podcast. So I'm going to let each one of you do your own self-introductions of your background, what you have accomplished in the world of insurance, securities, and crypto. So Susan, if you want to go first, and then David can go next.
Great. Thank you for having us, Jeff. So the thread through my background really is insurance in all sorts of guises. So I went into insurance by chance because in my first job, I'm actually an accountant, a CPA in the UK. And I was put into a team that was doing insurance audits around Lloyd's of London, which was actually pretty cool for a first job. And after that, I had all sorts of different roles in the insurance industry, credit analysis, equity research, and then head of investor relations and head of strategy for the reinsurance business of Swiss Re. And then as an insurance expert for the IFC, which is part of the World Bank Group. And it was while I was at Swiss Re back in 2014 that I first kind of encountered things to do with crypto and blockchain. And we can talk about what happened or what didn't happen in that area later on in the podcast.
So I'm David Crosbie. My background is I created a series of venture-backed tech companies over the years, which I sold. Back in 2015, I joined the faculty at University of Pennsylvania. I started teaching entrepreneurship, and then quite a lot of my students started coming to me with their crypto woes. And so I built up a crypto program at University of Pennsylvania. I taught the first crypto blockchain course in the computer science department. And then I also taught at Wharton. So I had the early exposure to the industry from a teaching perspective, and certainly through my students from seeing how it was developing at that point. COVID came along, the teaching got shut down, like everywhere else, and I was asked to go to the Securities Exchange Commission in Washington as their technology expert for crypto, where they were busy trying to build up some guidelines for industry and some understanding of how to regulate. So I ended up joining. I ended up learning a lot about the law of securities and finance. I did things like the technical part of the custody paper and another one on crypto trading. And then I got pulled into some of the big crypto cases, Do Kwon and Terraform Labs, Bankman-Fried and FTX being two notable examples of those. And that really gave me an idea of just how big and widespread these ventures are and just the impacts they have. Obviously, as you know, the whole regulatory space has been reorganized. I came out of the SEC end of last year when I realized the changes were coming. And I have been working the last 6 months or so for a series of tech startups, helping them with their strategy. So that's how I come into this space. So I have both the technology understanding and I have the regulatory understanding.
I know our audience probably have questions. I have so many questions. So I'm just going through both of y'all LinkedIn on another monitor, right? I'm looking through both. Susan, you can just, not in details, right? But you can give us a broad idea. You were at Swiss Re for 9 years as head of strategy of reinsurance. When you are a reinsurance company and you're running strategies, what are some of the things that people don't know about that job? Like what was tasked of you to do, to think? How does reinsurance company get ahead of other people? Thank you for watching this video. Now a quick message from our sponsor, Mav.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like Mav to qualify, quote, and hand deliver the highest intent qualified leads to your agents. Mav takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of InsurTech's $15,000 worth of credit to try Mav. Head to hiremav.com/InsurTechs to claim this offer.
The interesting thing about big insurance companies and reinsurance companies is kind of about everything, right? Because anything that can be insured, you know, whether it's cars or buildings or reputation risk, or now things to do with crypto, which we're going to talk about a bit later, is part of their business. So we were looking a lot, it was across all the lines of business, so P&C, life and health globally. So we were looking a lot at kind of how the business was performing, how the relationship was with different groups of clients and how they were performing, and then new areas to get into. So for example, further developing the health business, looking at going more into emerging markets, and looking, which is relevant to this topic, it was really the beginning of InsurTech, right? When I was the head of strategy, I actually went to an incubator in the UK run by Barclays, and that's where I first encountered a company which is still going, actually, which is nothing to do with Bitcoin or cryptocurrencies per se, but it's to do with using blockchain initially for tracing diamonds, and now kind of rare minerals and that kind of thing. So yeah, it didn't necessarily turn out how everyone expected, right? In those days, founders thought if they use not so much like crypto and Bitcoin per se, but blockchain in their pitch, they'd raise lots of money. And most of them didn't need to use blockchain at all. And actually then it had almost like the opposite effect, which is everyone was like, this is nonsense, nothing's happening. And now I think we've actually got to the point that, you know, there are real use cases and real things are happening, some of which maybe we like, some of which we don't like. So it went from kind of hype to derision, and now it's coming more into like practical things, in my opinion, and reality.
I think on that front, what we've seen is the dramatic change in regulation, or just the removal of regulation, has just opened up this large space where people can do pretty much as they like. And so moving quickly, occupying space is the key thing to do in this at this time. What happens later on when the regulatory pieces can't start coming back into place is not clear. There's going to need to be regulation brought back in, simply because there's such an opportunity at the moment for widespread fraud, frankly. There's really nobody guarding against that in any meaningful way. And the problem, of course, with that is it drowns out all of the good ventures, because if you don't have to pay much attention to reality, you can promise much better returns than people who are actually doing the right thing.
If you were not around in the crypto space in 2020 of March to August of 2024, when David was at SEC, David, just give our audience one little glimpse of the size of the fraud or the ecosystem that impacted on the Terra and FTX and Alameda and Binance. What was the size of the scale of some of those impacts?
Well, you're looking at different things in the different examples. What you're seeing in some of those examples is widespread money laundering and movement of money, particularly by North Korea. What you saw in the case of Terraform Labs was billions of dollars of imaginary money being created. And that when Luna Terra pair collapsed, that got taken out of the crypto ecosystem. That just disappeared. And that took a lot of people down with it. There were a lot of individual investors who were attracted by the 10% yield, who leveraged their houses, who borrowed money because it seemed like a sure thing. And like all sure things, it just came collapsing down, and it ruined thousands and thousands of people's lives. We got completely inundated with letters from people telling us how they had lost everything in the collapse of Terraform Labs. FTX was slightly different. There were obviously a lot of people had their money locked up in the exchange when it went down. Amazingly, when it went through bankruptcy and came out at the other side, because of some of the investments that have been made in AI companies, plus the increasing value of the crypto, it actually returned to the people whose money was held up in it more than they had put in. But even so, they'd lost the opportunity cost of their money. And very many people had gone away and sold their money to somebody at a discount, or so that sold their interest because they needed the liquidity. So everybody lost out of both those cases. And in particular, the industry itself lost out because of the enormous loss of credibility.
Yeah. So now we're going to go into the episode. And I'd like for both of you to share. Crypto is moving into this space. There's no stopping it. And insurance has, there's so much money in the insurance world and the crypto world. The two sides going to touch. And then we're going to have use cases, which there's already use case right now with the startup of Meanwell raising $40 million as the first Bitcoin fully monetized on Bitcoin life insurance company, right? And we're probably going to see a lot more use cases in the future where both blockchains and crypto is going to be in the insurance world. So I'd like to start with you, Susan. What are some of the opportunities that you can see get developed in the startup world with crypto, blockchain, and insurance?
Yeah, so I think there are going to be some wacky things, right, that are not necessarily the best use cases. The first thing I see, and as I say, this is on the sensible side and, an opportunity for the insurance industry. I think it's going to be very much like we've seen with cyber, right? In the beginning, cyber's a new risk. No one knows what the hell to do. They start putting in exclusions, but then you start being able to get cyber insurance cover. But to get cyber insurance cover, you have to conform to certain standards, right? In some cases, you're having kind of like an ongoing relationship with the insurer who's monitoring what you're doing and helping you with prevention and all this kind of thing. And I was actually on the board of a company and we kind of told the management, get cyber insurance. And they did, but they had to go through a process to actually kind of improve and document things in order to be able to do that, which we thought was a positive and was going to attract more investors. So the first area I see is as crypto becomes more widespread and more mainstream, driven partly by relaxing of some regulations that will allow more kind of like banks and mainstream companies to get involved in different ways. I think there's an opportunity for the insurance industry, and we are seeing a few specialized covers here already, right? Particularly in the Lloyd's market, and this is a thing that's kind of ripe for MGAs, I think. In ensuring kind of crypto exchanges, kind of potentially, wallets, and ensuring companies in the crypto space. And there are going to be more of these. There are specialized companies already. And given what David was talking about earlier about less regulation, I would expect more kind of like mainstream banks, payments companies already working with stablecoins, for example, foreign exchange companies, etc., to get into crypto. So I think the first thing is kind of insurance around that, a bit like we have seen with cyber. And of course, it's linked to cyber. So you have to look at your cyber policies. What happens if it's something to do with crypto. Then you've potentially got some kind of specialized things that maybe David can talk about a bit more later. One which I can imagine is if you have stable coins, which are supposed to be pegged to something and then they're not, or something like that, that could be a case for insurance. And then you've got one of the initial use cases, which is this, which hasn't really developed as much as everyone expected, in my opinion, which is this smart contracts on blockchain. And that may or may not have anything to do with crypto, although I think if stable coins become more common, there will be more of these type of things. But here, as you know, and most of the listeners will know, we're talking mainly about parametric, so index-based insurance products, which can basically be, if the trigger point is hit, it automatically is going to process it on the blockchain, and you get paid your money. So we have seen quite a few of those, particularly in developing markets, and for a few kind of like short-term things. I think there was one on flight delay insurance and things like that. I think this is a valid use case. It's covering real risks. The question is, particularly when you're in emerging markets, what happens at the end, right? How do you actually get the money to the small farmer or whatever who's covered? And there, to make it work, you need some kind of wallet. And so the question is, how easy is it to set these things up? Some of the people don't even have bank accounts. Are we going to end up with all of us having stable coins in wallets and that type of thing? But it's not impossible. It does deal with real pain points. It's just that it's a bit more complicated to do it in practice than it sounds in theory. And David, I don't know if you have some comments on those things.
Yeah, so I'd sort of step back and go, what are the couple of big trends we're seeing at the moment? The first real big trend you're seeing is crypto coming into the mainstream investing markets. You saw that with the launch of these exchange traded funds, initially for Bitcoin, and you're seeing them for a whole bunch of other cryptocurrencies. You seeing the mainstream investment companies adding crypto to their offering. I saw my Schwab sent me an email a couple of days ago telling me that I could now buy crypto via my 401k alongside all my 401ks and everything else, though I don't think I can put it into my 401k except through an ETF. Part of what's driving that is a desire to attract a younger generation of investors. The second point is that the margins are extremely high. You make very high margins on selling crypto. So those pieces are coming in. You're also seeing people like MicroStrategies, I think they're now called Strategies today, who have a strategy of buying Bitcoin. Because they're a tech company, it enables funds that can only invest in tech companies to buy their shares and get an exposure to Bitcoin. And you're seeing that essentially for every dollar of Bitcoin, their valuation goes up by $2. So those things are large scale deployments of crypto into generalized investing space. That requires significant amount of custody, all the pieces around custody. That requires insurance in case you lose the key. The key issue with crypto is obviously that once you have moved crypto from one wallet to another, there is no technical way of getting it back. And so if you make a mistake, it's a permanent mistake. And some of the mistakes that are being made are very large amounts of money. So there's a very obvious opportunity in the insurance market for insuring against those sort of risks, and at the same time ensuring best practice around them. The second big wave that we're seeing is this stablecoin wave. Essentially, a stablecoin is a digital token whose value is guaranteed through various methods to be equivalent to, say, a US dollar. So if I transfer a stable coin worth $100 to Susan, then I have effectively given her $100 worth of value, and she could go to an exchange and convert those into $100. That gives you opportunity to be able to form an alternative set of rails to move money around the world. It's particularly useful in going across currencies. It's particularly useful in more thinly trading currencies around the world. And you're seeing that go from a pretty much a niche activity to being fairly mainstream. There's a couple of pieces of legislation in the States, the Stable and the Genius Act. What was the other one, Susan?
The Stable Act and the Genius Act.
Yes, those two acts, which will effectively move regulation of stablecoins from a few states like New York State and Texas into the federal level. It'll also make them available for being protected under the FDIC protection, depending on how they're structured. So you'll start to see that as a big push. You're seeing Bank of America make more noises. They too want to get into that stablecoin space. So those are the two big crypto trends. And obviously beside each one of them goes risk, and therefore with risk goes the insurance industry. The other thing you have to look at is that if there are stablecoins, they require collateral to be invested somewhere. Treasuries is one place, but you can imagine them being invested in other activities that generate income. And so potentially the insurance industry could play a large part in managing that as well. And ensuring, because you need the guarantee that that 1-to-1 ratio is there. And one way of doing it is to make sure you have it all in cash. The other alternative is that you have it in with some form of guarantee. So those are the two big picture trends. Over to you, Susan.
Yeah, it's interesting because I think what this is challenging, in my opinion, for traditional kind of like E&O, errors and omissions, and D&O, directors and officers covers, right? And this is not a positive point about the industry, even though I've built my career in the industry, but they do tend to, like, the first thing is like, oh, we're going to exclude it. But to David's point, this is happening. It's not totally an esoteric, like, niche area. It involves big companies and all the rest of it, right? So I think we're going to see a mixture of kind of large brokers, which we're already seeing, and some large insurers like, okay, we're going to really try to understand this stuff and be able to deal with it. And then, as I say, I think you're going to see some niche players who are going to be specialists in this area, because with all the, there are some good business cases, right? But with all the pitfalls that David spoke about earlier, you better know what the hell you're insuring, right? In this area, you wouldn't want to give like carte blanche to just underwrite, anything crypto. That's an absolute, that would be an absolute nightmare.
Give our audience backdrop. On Grok, as we are having this podcast recording, the global stablecoin market size as of April 2025, the time of this recording, is 241.8 billion. Estimated growth this year alone, and I'm sure this is a conservative number. I think Grok is conservative. I don't know. Is to 400 billion by end of this year, and by 2035, stablecoin market is going to be 1.1 trillion. All right, here's the next one, and using for cross-border payments, store value, assets, currency, commodities, blah, blah, blah. Global reinsurance market size, as of today, this recording, 478.58 billion in 2025. Projection growth by 2030, over the next 5 years, is to $626 billion. So I have a random question, and I might not be as familiar with the global reinsurance market. Is there a global reinsurance market exchange that's globally where all the reinsurance companies are being listed outside of stock market exchange? I mean, is there a participation exchange? Thank you for all your support to our channel. Here's a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
No. So, but by the way, just before I answer that, yeah, there's been a lot of reports. David and I are actually writing a series of articles about crypto becoming mainstream, covering different topics. And recently, Citi published a report that was quoting similar numbers to what you're saying. I think they were forecasting as a kind of central case, stablecoins growing to 1.6 trillion by 2030, so even a little bit more than grok. So I think we need to. There are two things here. Like in my view, the stablecoins already. There's a lot of volume, more than Visa and MasterCard, right? And we think that's going to grow, and David can talk about that a bit more in a minute. The issue, though, for the insurance industry, right, is what has to be insured. And what has to be insured is things like, as we've discussed, losing the keys, maybe the stablecoin stop not being pegged to the dollar, kind of more traditional D&O and E&O things, right? So even if the volumes grow hugely, if we can sort out those things, it's an opportunity for the insurance industry. But what I think you've highlighted, Jeff, is that when we're talking about all things blockchain, you're talking about kind of 24/7 trading, right? That's why it's interesting in terms of moving money, foreign exchange, cross-border payments, the kind of things that you have both been talking about. That is definitely not how the insurance industry works, right? You have some startups that are trying to be fast and use AI and so on for personal lines like Lemonade. But when you're talking about reinsurance companies, it takes weeks and months to to even renew a policy, let alone get a new policy. So I think there is a big picture question about if we're going to have this kind of 24/7 non-stop on-chain type activity, traditional financial services like banks, insurance companies, reinsurance companies, whatever, this is really not the way they work now. And what does that mean for them? And I think it's an opportunity and a threat, because there's some real friction in things like payments and cross-border payments and so on, but which needs to be solved for the customers. But it's definitely going to kind of change the way we work, and even change the way that we think about kind of like trust and verification and all those kind of topics. And we're only right at the beginning, I think, of talking about this. Do you want to add to that, David?
The only point I was going to make is that hard boundaries are it's very hard to limit the flow of tokens to one geographic area. Once they are being circulated, they circulate around the world. It's basically impossible to block them going to anybody. And so when you think of it from an insurance perspective, you may well be finding that you're insuring an entity where many of the assets in the way of crypto tokens have flowed to pieces of parts of the world which are outside the US regulatory regime. So you're looking at a very different set of requirements and constraints. You're also looking at a potentially different set of people who can insure, because you can start to look at the opportunities for creating insurance pools where people contribute towards a risk pool by moving their tokens into that risk pool. We've seen something equivalent in the betting market, where we've seen what traditionally was people bet on the outcome to sports, moved into betting on political races, and that has become a crypto venture as well, where people put money in on either side of the bet. And you've now got a functioning betting market. You could easily see the same thing occurring in the insurance market, where it pulls in funding from a much larger pool of people. And that changes the whole dynamic as well. So you're seeing a more complicated risk profile because it's hard to have these geographic boundaries, and you're seeing the potential to expanding the risk sharing through a number of methods to share the risk between participants.
Yeah, I mean, we've seen, maybe just a final comment, I think we've seen that a bit, right, when I think one of the exchanges got into trouble and their kind of competitors were helping them out. So I think there is a possibility of some kind of like crypto industry pooling to deal with some of these things. And that actually probably makes sense, because then you have a sort of higher layer that's more insurable or reinsurable. So that wouldn't surprise me. So maybe we end on that positive note.
I just have another thought, another question I've been thinking about for a long time. If our cyber insurance segment, right, like they say cyber insurance 5 billion is going to go into 20 billion with all the rising global risk, and most of the cyber insurance payout is settled in crypto, right? It's settled in Bitcoin or other forms of crypto. Most of the insurance company are taking in the coverage for the cyber insurance policy with dollars, and dollar inflate and deflate, right? And then if the payout is always going to be in crypto, then is there custodian crypto company out there that's working with all the insurance companies?
So be careful here. The what people are paying in Bitcoin or whatever is ransomware attacks, right? It's not that the claims are paid in crypto. If you have a cyber claim, the insurer will pay it in dollars. But one of the first things that brought the discussion of Bitcoin into the boardroom was companies saying, oh, do we need to hold some Bitcoin in advance in case we have a ransomware attack and we decide to pay the ransom? Now, obviously, whether you should or shouldn't pay the ransom is another story. But I mean, there are, and David talked about this a bit earlier, there are various, custody operations. And by the way, there are some insurance companies. I mean, you referred to the new company that's trying to be totally Bitcoin, right? But there are some mainstream insurance companies that have, in their treasury operations invested a little bit in Bitcoin. And I hope that they do have proper custody arrangements, because your normal, treasury folks and risk management folks and internal audit folks are not really clued up on this stuff. So if companies are going to hold Bitcoin or other cryptocurrencies for whatever reason, they really need to look at okay, who is going to be the custodian? And then on top of that, what kind of controls do they have, and what type of insurance, and so on and so forth. And some of the custodians that are specialized now kind of publicly say, yes, we have insurance if things go wrong. So I think that's how it's going to work.
The point I was going to make before, which I should have made before, was one of the reasons why you see the crypto exchanges stepping in and helping other crypto exchanges, which are obviously their competitors, is because of the volatility of the market. You saw how when Mt. Gox went down, it brought down the whole crypto industry for a long period of time. So they have an error by one crypto company has a dramatic impact on the other crypto companies as well. And effectively, the only people at the moment who have the depth of funds to provide that insurance are the other crypto companies. So you're effectively looking at a mutual insurance arrangement. There's obviously settlements going on behind the scenes in exchange for propping up that exchange at that moment in time. But I suspect that is what's going to continue at the exchange level. I suspect the amount of money involved and the difficulty in assessing the risk and the size that potentially can get lost is going to mean that's probably the only way those exchanges are going to be able to get their insurance. Susan.
No, I agree. So I think we're talking about a captive for the crypto industry, right? In insurance language.
What about insurance for crypto companies, insurance for crypto startups, insurance for tokenization ecosystems, insurance for custodian in the crypto space? Like, David, when you advise some of your crypto startup founders, where do they go to get their own insurance?
On the crypto side, they don't. It's too expensive. It's not possible to get insurance.
Is there opportunity to build one of the biggest insurance company, just focus on insuring crypto companies?
So I would say, just as a final point now, because someone's going to call me in a minute. No, because you've got problem with diversification, right? We all saw what happened with Silicon Valley Bank, and you'd be doing a similar thing in the insurance industry. So I think there's an opportunity for the insurance industry to insure crypto things. But first of all, they have to come up to a certain standard, right? Which, as David said, when you're an early stage startup, you can't, and the insurance would be too expensive. It doesn't make any sense. I think you're going to see some specialized MGAs in the crypto space. But if you're unlikely to want to be a company that only focuses on that, because as David just said, it's very volatile, and when things start going wrong, it can affect other people. And diversification is one of the whole points of insurance. But I do think there are opportunities there. You just have to be kind of careful what you're doing.
I think if there's a need, there's always going to be people who are looking for opportunities. But go ahead, David.
Sorry. So there's a couple of points on that. The first is that there are lots and lots of high quality startups in this space. There are all equally a number of pure scams, and it's extremely difficult to differentiate between the two. The problem for the industry is those scam startups will often stage a quote unquote security exploit as the way that they do a so-called rug pull, the way that they withdraw money from their system. So rather than saying, oh, well, we've just taken all your money, goodbye, they will announce that there was an unexpected exploit in their smart contract and X million dollars has gone missing and they are busy negotiating to get it back or whatever else. There's been a number of cases where those quote unquote errors in the smart contract were hardwired in from the start. And it looks very much like they were a part of this intentional so-called rug pull. So as an insurance company, you would have to be, you would need to be able to audit those smart contracts. And indeed for startups, that's what they do. They go to a third party to get their smart contracts audited. And that's a very significant expense for a startup. So what you're seeing is that the risk for a valid startup is the scammy part of the industry drives up the cost to them because people are continuously worried that it's just a scam, and it makes their success less likely. The more you take regulation out of it, the greater the risk of that occurring, the harder it is to provide insurance. And so the more likely you are to have a very, very volatile industry. That's why the industry will be pushing to put regulation back into this space.
I feel like we need to do like episode 1, episode 2, episode 3. There's so much to cover with all the ideas and where the industry is flowing to. David and Susan, thank you for coming on the podcast episode, and I'd love to have you guys come back on for another recording. So this way that we can go a little bit further and dive a little bit deeper in some of the conversation we talked about.
Thank you. We'd love that.
Thank you very much.
Thank you for tuning in.